a man who needs no introduction, and I'm very humbled. I hope you don't mind, I'm going to say this. He said he looked at our agenda last year and was a little offended that we didn't invite him. And so this year, he was the top of our list. Jonathan McKernan has been a friend since his time at the FDIC, and I followed him when he was a Senate staffer and sort of doing the work that he did. He's been a leader on financial services innovation issues for a long, long time. And finally in a position today, I think more than before, to really have a tremendous, tremendous impact. Jonathan's been a friend of not just AFC, but to the entire ecosystem for a long time. And I am excited. I am legitimately excited. I don't know if you could tell. I'm legitimately excited to have him here to kick off our panel. Being interviewed by by one of our founding members, SoFi, Farah Zubair. Come on up here. Let's get the show started.
Well, that was some introduction. Wow, thank you. Appreciate it. Morning, everyone. Is this okay?
That's perfect. Good morning, everyone. Good to see so many familiar faces over here. You know, we're very excited to get into this conversation. Jonathan, thank you for taking the time to be with us. We have a lot of topics to get into, so I'd like to jump right in and start with your vision specifically. So in your role as Undersecretary of Domestic Finance, you have a broad remit and play a central role to crucial policy conversations for the modern banking system. To set the stage for our discussion today, could you please share your vision on how Treasury can encourage responsible innovation in financial services and ensure the industry, both American banks, fintechs, financial institutions, remain globally competitive?
Great. Thank you all for the opportunity to be here. I did feel a little left out last year. I guess I shouldn't have admitted that, but it's so great to be here. And I get to go before my friends Travis and Jonathan today. So thank you. The energy, you can sense it in the room when you get here. That's just fantastic and really bodes well for the country. So yeah, your question's exactly the right starting point. I think the way I think about things, we shouldn't take any of the premises for granted. And we need to make the case for responsible innovation. I think that's one of the things that Treasury really centrally needs to do. One of the things that I find so rewarding and exciting about this opportunity to work for the President, Secretary Westin, is I think this administration is very unique in its emphasis on growth, really as a moral imperative of the time, right? Economic growth is important in its own right, not just because it fosters, it makes us able to feed, clothe our families, but there's a lot more to that, right? When we grow, that gives us more human opportunity, more chances, right? When we grow, we foster a sense of forward-looking optimism. When we grow, we're able to pay our national debt, to meet our obligations to the old and firm, to build a military that can protect America. So growth is really central to the American experiment. It always has been. And the way you get growth is through innovation. It's what drives up productivity growth. And maybe the contrast here with the last administration is we have really embraced innovation as a driver of growth because the alternative really is stagnation. Stagnation is not stationary. If we don't grow, if we surrender to stagnation, we're going to turn on each other. That's going to foster strife. It's going to foster pessimism. The alternative here is to really lean in to growth. So I think that's first. We've got to make the moral case for economic growth. Second, Treasury, I think, has a unique opportunity here to define a strategic vision for what kind of financial system we want 10, 15, 20 years from now. My experience at the FDIC the last 2 years is too often there's this, call it regulation by reflex, right? Sort of responding to the latest, whether it's SVB or some other episode. We just pile rules on top of rules, more rules on top of rules, without kind of anchoring the regulatory framework within a sense of the system, the financial system we're trying to build. We need to situate innovation at the center of that vision, community banks, a diverse, vibrant financial system, and then ensure that the financial regulatory framework furthers that vision. Now, concretely, the way we do that at Treasury is we just have a very powerful ability to convene the regulators together. So we're doing that to help define strategic priorities, whether it's on capital, liquidity, supervision, AML, innovation, and then maybe most importantly, it's just a matter of almost like project management, right? And kind of continuing to drive and emphasize the urgency of reform, the urgency of getting this done now, right? And holding folks to account to make sure that they execute on that agenda. And I think you see that paying off already now. This administration has moved very quickly through the bank regulators to launch a whole series of regulatory reforms, and we're just getting started, a lot more to come. But I think that's where Treasury really finds itself right now, making the case for reform, stating the vision for the financial system, and ensuring that we're actually executing on that vision.
Yep, that's great. And we've certainly seen a lot of that kind of come through in terms of just broader innovation and embracing it. Wanted to pivot a little bit and really speak to how you balance those regulatory considerations. So we're now just a few weeks after the 55th anniversary of the enactment of the Bank Secrecy Act, as I'm sure many of you are aware. More recently, we've seen a real and distinct need for modernization in the BSA AML space. What are your views on where the U.S. can and should modernize Bank Secrecy Act requirements for a more effective anti-money laundering regime?
So absolutely should, definitely need to prioritize AML, CFT reform here. I do want to be mindful that, as Undersecretary of Domestic Finance, this is not within my lane. Undersecretary Hurley and I have a very good working relationship on this issue. He's, I think, been remarkably open to views on this. But my views, for whatever it's worth, you talk with the banks, the financial industry, and BSA AML is in the top 2 or 3 pain points. For community banks, it's next to culture of supervision, which actually relates to AML, maybe the second or third, depending on who you talk to, pain point. I think here it's important that we careful on how we define the problem. And as I see the problem on the AML side is, we have a statutory requirement that financial institutions adopt reasonably designed, risk-based processes, controls to identify, assess, and mitigate their illicit finance risks. This is not to say there should be no illicit finance passing through an FI, a financial institution. It's kind of inevitable. It's a risk-based regime. In other words, you need to have an effective AML program. Instead, what we've had is especially at the banks with the examiners, a very process-focused regime that looks with the benefit of hindsight at whether there was an opportunity to maybe have enhanced some process to have prevented some identified illicit finance. We shouldn't have that kind of hindsight 2020 perspective. Instead, what we need to do, I think, as an administration is very clearly, objectively, and like self-defining language, specify each of the conditions that needs to be satisfied for you to have that effective risk-based program. And then we need to go and situate FinCEN as more Treasury, is more of called a gatekeeper, and ensuring that the examiners at the banking agencies, who tend to be more process-focused, are really looking at banks' programs relative to what we're trying to achieve is effective programs. And I think that requires a new program rule. The Undersecretary Hurley is hard at work on that. Very excited to get that out, and just to show how impactful the changes can be there. He's already got out some frequently asked questions, I'm sure many of you all saw, on no documentation decisions, continuing activity SARs, structuring SARs, incredibly consequential work, but a lot more to come there. Key here, though, is clarity on the regulatory expectations so that we can then leverage that clarity to drive a change in the culture of supervision at the banking agencies to stop this hindsight 2020. But if I'm thinking about the problem the wrong way, I hope you all will come visit me and tell me how you think about it. But boy, this is certainly top of mind, not just because it's a huge burden for the community banks, but also the way it kind of tends to get implemented. It has a real barrier towards innovation in the financial space.
Yeah, and on that too, in terms of broader tools that potentially community banks and other institutions that are looking to really get in front of this, How do you see the use of RegTech and SupTech tools in particular being leveraged to really support in terms of improving PSA AML compliance and also improve the efficacy of those requirements? How do we leverage those tools both from a regulated entity perspective, but also from the perspective of regulators in efforts to really combat illicit activities?
You're absolutely right. It's two dimensions, right? The regulated entities and at the regulators. And candidly, we're not doing a whole lot right here on the regulator side. Hope we will address that. It's been 9 or 10 years now, but one of the last big matters I worked on when I was in my banking law days was with a consortium of larger financial institutions that were sharing information under 314B, transaction information, and using what was at the time quite advanced technology to mine for typologies, predictive indicators of illicit finance activity. And what came out of that process was incredible, like things that as predictors in hindsight made a lot of sense, but none of us in this room would have kind of imagined, oh, if we look at X, we'll see like some high probability indicator of illicit finance activity. So that really captured, and this is 10 years ago, I'm sure the technology is much, much better now. So we as regulators need to make sure this program rule I just talked about gives you credit for adopting these innovative technologies when you're building out your program. That includes, I think, credit for when you engage in information sharing with your other peers, right? Because I think we will have not just more effective programs at the bank level, but a more effective illicit finance regime if we think of this more of like a system issue as opposed to like bank by bank, right? Because the bad guys, they know how to structure their transactions, spread them out across institutions to help reduce the likelihood of detection. So both the credit for innovation and also the credit for information sharing. Concretely for me right now, top of mind, is we keep hearing from the banks that the existing model risk guidance is a significant hurdle to adoption of some of these advanced technologies. That, for instance, when you identify a typology using one of these technologies, that some of the examiners view that typology as a model that needs to undergo thorough validation pursuant to that guidance. Now, how we got there, I don't know, given that the guidance's scope is supposed to be limited really just to quantitative factors. This is one of the things you hear pretty often, especially in AML, is the examiners really pushing the limits on what they're supposed to be doing, even maybe going beyond those limits. And so we need, I think, very urgently to address this model risk guidance, not just for AML and these typologies, but also for AI, to get it really focused on where it should be, on the key financial models underlying the systems. But I think that's top of mind for me now, and then hopefully getting into the program rules, some good credit for adoption of technology and information sharing.
That's great. So I'm going to switch gears a little bit here and talk about the non-bank payments landscape, which has significantly developed over the last decade. A number of conversations are happening, chartering conversations with the prudential regulators, and Federal Reserve Governor Waller, of course, discussing a skinny master account for eligible payment services entities. What are your perspectives on a skinny charter for payments companies, and how do you foresee a payments charter impacting the bank fintech partnership space?
So
I had to ask.
Yeah, no, I love the question. I just love the question. So I was so intrigued and eager to see Governor Wallace's speech. Kind of got a little bit of a preview and was very excited. This is one of my favorite questions. I think this is one of the defining questions of the time, and so I love the entrepreneurialness of the concept, and I hope we will take it very seriously. It deserves careful study because we've had this historic, I call it like a bundling of payments with maturity, liquidity transformation, and I think I struggle to find in the theoretical literature like a strong case for why we should legally mandate that bundling, right? That said, this has been a feature of the financial system for a long, long time, and I tend to approach things from a rather cautious, careful, incremental perspective, kind of like a concession to epistemological modesty here. And so I think what's very interesting and really deserves careful study of Governor Wallace's proposal is that it is incremental in that direction, right? It doesn't go all the way, but it starts to take cautious, calibrated steps towards fostering innovation and the banking system and the payments system. So love the proposal. We'll be very eager to hear folks with more thoughts on it, and I hope that the academics also engage, because these are big questions about, again, Treasury needs to think about what kind of financial system do we want to see 10, 15, 20 years from now. And this is one of these questions that will have compounding implications as we move forward and how we decide it or don't decide it. That implicitly is a decision of its own.
Yeah, fair to say we're going to see a lot more developments on this topic in the coming months. I want to stick to the payment space, of course. Digital assets and stablecoins have had certainly their policy moment in this prior year with the, momentous passage of the Genius Act and the, likely passage of Clarity. How are you viewing the regulatory and market developments in the digital asset space?
It's exciting to see the innovation in space, the energy in the space. It's a good reminder of what's unique about the United States and the American experiment. I hope we'll continue to see that. I'm very eager to hear how the financial regulatory system can be reformed on the margin to foster these activities. I guess the one note that I would say here is we also need to be mindful, and I know all of you are, that we also involve responsible risk management in this adoption, right? If we do not have a principle-based, expert risk management team at each of the institutions that are leaning into this, we're going to regret that down the road. I know from my time at the FDIC, there are folks who are just looking for any excuse, right, to regulate this stuff out of the system. They'd rather kind of keep things the way we are now. And if we don't have that risk management culture brought to bear with kind of the forward-leaning entrepreneurial spirit, we're going to regret it, because we're going to give that, somebody that opportunity down the road. So I hope you all are doing it. I'm sure you are. But boy, it's just so thrilling to see, America be America really becoming and reasserting itself as the leader of the world when it comes to crypto.
Yeah, really well said in terms of balancing the risk management considerations here. At SoFi, we're super excited about what this means for consumers. We were the first U.S. bank to launch crypto trading for our customers. So I have to ask you, what do you think the banks and fintech companies in this room who are engaging in digital assets activities should be considering as they become more involved in this space?
So again, I just go back to careful focus also on the risk management side, and then please keep us in mind as you see obstacles here. We're really doing our best here to drive a change in the culture of financial regulation, really an embrace of responsible risk taking, right? We don't want to push all risk taking out of the financial system. And that's the point of the financial system, is to manage risk. And to the extent we're getting that done, great. To the extent we're not, eager to hear. But let's just, again, I don't mean to focus unduly on that, because the promise and the potential here is so exciting. But always, let's be very careful that we're also doing the risk management at the same time.
A quick follow-up on that one. Are there things that we can be doing to ensure value is provided in return to the consumer?
That's interesting. Well, pushed it down to lower price. I mean, we're going to see that through the competitive system, right? But I do think it's important that this shows up as lower prices, more choice, better risk management, because you've enhanced it with the latest technology. But I'm sure you guys are all doing this, and you can see it in the better interfaces that we have now. Compare a mortgage underwriting process now to what it was 10 years ago. It's night and day. So it's really thrilling to see the extent and this pace of change within the financial system.
Well, I can't leave this conversation without bringing up AI, of course. The financial services ecosystem has been booming with AI conversations and applications over the past couple of years. Can you discuss how you and Treasury leadership are viewing these developments? And also, in particular, how do you see AI changing the financial services industry?
So I think the focus right now at Treasury is really twofold. Of course, we try to be mindful of the potential risks that can come out of any new technology or new activity, but maybe well, equally important is identifying the impediments to adoption, both by the regulated entities, but also at the regulators. So we have now underway a process kicking off. We'll have some forum, some engagement with market participants where we will try to, understand model risk guidance. What other aspects of the existing regulatory framework restrict potentially adoption of AI, both enhanced the product offering, but also in risk management, for instance, on the AML side. And then we also, in the governmental space, need to be pushing to have responsible adoption of AI within the system. Treasury we have ChatGPT now. That was amazing to me that we got that done pretty quickly. Credit to a few folks that have really been forward-leaning and pushing through some of the bureaucratic hurdles you would otherwise see within the government. But we need to go further than that. You mentioned AML. There are just the opportunities with AI to detect whether it's fraud in some of these programs or to enhance our ability to generate good information, actionable intel. The promise is incredible. So it's both on the regulated side, but also at the agencies. We need to really lean. I think we're doing that, but we can't take the foot off the pedal, right? I'm a little bit of a GPT addict myself. The South Park episode, my wife sent that to me. It's like, this is you, like, stop talking about GPT. I took that point home and have tried to dial it back a little bit, but the promise is astounding, and we need to really be leaning in here to make sure that we're not just the crypto capital of the world, but also the AI capital of the world.
Fair to say, I think we're scratching the surface with AI and certainly seeing both, across the institutions and also regulators really start to embrace that. So it's been wonderful. This has been a great conversation. With the time we have left, I wondered if you could touch on other policy issues you think are important for Treasury to engage in order to encourage responsible innovation, which we talk a lot about here with AFC, of course, the importance of balancing those risk management considerations that you already touched on. So just general policy areas that you're super tuned into right now.
Yeah, so top of mind for me is trying to think more creatively about the financial system of the future. Very challenging because, of course, whatever we can imagine is not actually going to be where we end up. And then working backwards from there to think about what needs to change in the financial regulatory framework. More concretely within that, I come from more of a banking background. My mind often tends to go there, but we have had a regulatory framework that has just pushed risk out of the banking system to the non-bank sector. Now, if the non-banks compete with the banks on a level playing field, and that's just where the intermediation ends up, great. That's an efficient American economy. But if we're driving intermediation via regulatory arbitrage or otherwise to the non-banks, this is a problem, right? And I see that especially on the capital side, the regulatory capital side. Worked on the housing giants, Fannie and Freddie, for a long time. I think you see a lot of the growth in the GSEs driven by a regulatory capital arbitrage dynamic where you take a 50 risk weight mortgage and you pay a G fee, guarantee fee to the GSEs, and you get back a 20% risk weight agency MBS. That's an arb that the banks are going to take advantage of all day, and you're going to concentrate credit risk in a few monolines. So I think that dynamic, we're going to get that fixed with some changes to the regulatory capital framework, align those credit risk capital requirements with the latest, greatest understanding of risk. I think that will do a lot to sort of level the playing field between bank and non-bank execution. That's on the asset side. Like an emerging issue topic for me, more on the liability side. This kind of goes back to the question on the skinny bank, on the skinny accounts. We've had in banks funded by, I call them, it's not the right term, but payment-related liabilities, deposits, payment-related liabilities, low interest, pretty sticky, generally speaking, long duration. Like it or not, technology is going to pressure that dynamic. And to the extent then that the liability side is undergoing a similar pressure that you have on the asset side with banks, where the duration's shortening, the cost is going up. That is a profound change in market structure that we need to think about, like the implications of that, the implications for consumers, for growth, for credit, maturity, liquidity, intermediation. Again, it's not our job to stand in the way of change. In fact, we should be endorsed, but we need to make sure that these are things that are driven by fundamentals and not by the regulatory framework, and that then also we are thinking ahead as to what that means for the financial system. So this, I think, is something that Treasury is uniquely well situated to do. In the past, I think policymakers have tended to surrender these issues to the banking agencies, and these are questions that involve really important value judgments and trade-offs, and cannot be left to the technocrats, right? They have a role to play here in advising on how we strike this balance, but ultimately, you need folks accountable to elected officials involved in striking this balance, thinking about what the financial system of the future should look like, and ensuring that the regulatory framework is aligned with that, because very profound questions kind of being answered or implicitly being answered by not being answered as we speak. And so it's just a great time to be at Treasury. I'm thrilled to be there, be able to participate, and I'll look forward to hopefully seeing you all. You guys can hopefully share lots of opinions and views on where we're getting it right and where we're getting it wrong.
That's great. I just have one final question for you. Where do you see the best opportunities for regulatory modernization to continue to grow investment and engagement in the fintech space?
So to grow fintech and innovation, it's on the concrete things like model risk guidance, AML, AI adoption. These are what's top of mind for me right now. But then just generally, we need to have a healthy and vibrant financial system if we're going to have a financial system that not only funds, but embraces and adopts innovation. I think the bigger picture questions there are ensuring that our regulatory capital framework is really tailored to the underlying risk. That's on capital, latest and greatest evidence of the risk. It's across the system so that we can have a financial system that's driven by the fundamentals, by the technologies, by consumer demand, and not by regulatory arbitrage.
I think that's such a great, really well said, first of all, and second of all, what a great way to kick off the summit here. So I really appreciate you taking the time, Jonathan. A lot to chew on. I know others will likely feel similarly in the audience here. With that, I think we're wrapping up. Phil, we'll pass it over to you.
Thank you so much.